Hello and welcome back to Money Fuck Shit. In today's video, I'm going to talk about the most common investing mistakes that everybody makes, or at least everybody with a human brain. If you want to learn about them and try to avoid them, you can stay here. Otherwise, you can go make yourself a cup of kombucha tea or whatever. The first thing that you need to know about these mistakes is that they have a lot to do with the way our brain works. That is, everybody is inclined to making these mistakes, unless of course you're a robot. So don't feel bad if you're making them. Everybody feels the same way, or pretty much everybody. And don't have an attitude of, oh no, I'm smarter than that, I'm not going to do that. That's not going to work. We need to accept that we're human with a human brain, and human brain is awesome, but it has its limitations and we have to work with them. That being said, let's begin. The first one is investing only on things that you know very well and that you are passionate about. Understanding the things that you're investing in, that's a good idea. You should always have a good understanding of how an instrument works and what are the risks involved before buying it. You should be able to understand the basic mechanics of how that thing is going to make you money. If you're presented with an investing opportunity that looks like a black box with money coming in, money coming out, and you're not sure what's going on in the middle, well, that's generally a red flag. You should be able to understand how the thing works. But that doesn't mean that you need to be an expert on every single product, market, industry, or geographical location that you're trying to invest in. And in fact, you shouldn't be. That is because limiting your investments to your areas of expertise, it's a terrible idea. Even though it makes sense intuitively. Like, for example, okay, I have a lot of knowledge about this industry. I have worked there for a long time. I know all the people there. I know all the companies there. I know all the players. I know how it works. I know exactly what kind of business is going to be okay here and what kind of business is not going to be okay here. Why can't I capitalize all that knowledge and all that passion? Yes, you can invest, but only a tiny part of your portfolio on these kind of things. The majority of your portfolio should be on other things. And the reason for this is diversification. From a diversification point of view, investing only on the areas that you're an expert at and the areas that you're really passionate about, it's a terrible idea. Your portfolio needs to be as broad as possible, and naturally, you're probably not going to be an expert on a lot of things. If you limit yourself to the things that you're an expert at, your portfolio is going to be extremely narrow. Also, chances are that you're already pretty invested on all those things. Because if you know an industry very well, it is probably because you are already working there. If you know a city very well, or a country very well, it's probably because you are already living and working and doing pretty much everything there. So why would you want your investment portfolio to also be related to those same things? If something bad happens to the industry you're working in or the city you're living in, you don't want your investment portfolio to be also going down. So you probably want your investment portfolio to be as uncorrelated to your daily life as possible. All the things that you are passionate about are things that you are not only financially invested in, you're also very emotionally invested in. So if something goes wrong with one of these passions of yours, you don't want to be heartbroken and broke at the same time. Believe it or not, many studies say that diversifying too little is one of the most common mistakes investors make. For example, a study done by Brad Barber and Tara Sodin showed that the average investor had only 4 assets. There's also a strong tendency to invest on industries that are familiar to the investor, local industries, even the company that the person works for. I know that I sound like a broken record with this, but when it comes to investment, your mantra has to be broad and uncorrelated. Repeat with me, broad and uncorrelated. That's the way to fix this mistake. If you want to find a way to increase your diversification without driving yourself crazy, funds are generally a good tool for that. Number 2 is confusing play money with investments. I have absolutely nothing against fun and entertainment. You should have fun. You should entertain yourself. Okay. But the money that you use for having fun is not money that you're investing. You shouldn't mix these two concepts. The whole idea behind your investment portfolio is to build your wealth and to give you security. The excitement, the adrenaline, the dopamine high, all those things have to come from other parts of your life, not your investment portfolio. That's not the idea. Some people suggest having a portion of your portfolio dedicated to what is called play money. And the definition of play money is money that you could drain down the toilet and you wouldn't care. Well, in my opinion, the money that you could drain down the toilet and wouldn't care is not investment money, it's money that you are spending. Okay, you want to go to the casino? Go. You want to buy a lottery ticket? Buy it. You want to buy an expensive collection of rubber ducks dressed in cute outfits? Go buy that thing. You want to buy some NFTs of pixelated titties? Don't do that. The point is that yes, you can invest money in all the things that you just like and that give you joy. But you have to be honest about them and categorize them properly on your budget. Your budget should have a section dedicated to fun and entertainment expenses, and that's where you're going to put all these expenses. You're not going to categorize these expenses as investments. You're going to categorize them as expenses because that's what they are. Anything that you're buying primarily for fun is not an investment. The only money that you can say is an investment is the money that goes to assets that are part of a proven and systematic strategy to build your wealth and security. Nothing else. Number 3 is too much portfolio rotation. So these guys that I mentioned before, Barber and Odin, analyzed the positions of a lot of investors, around 65,000 to be more accurate. They divided investors in quintiles and they found that the quintile of investors that traded most heavily had the lowest return. The first quintile, the one with the most rotation, had a return of 11.4%, whereas the quintile with the least rotation has the highest returns, with an 18.5%. Normally, excessive rotation is due to overconfidence. That's a very common bias of the human brain. We tend to think that we are better than average at most things. We tend to think we know more than what we actually know. This false belief, paired with feelings of fear or greed, might cause you to make more adjustments to your portfolio than necessary. Some people can't understand that when they are adjusting their portfolio, they are making a lot of assumptions. For example, if you decide to sell something, you're not only assuming that that something that you're selling is going to have a bad return, you're also assuming that whatever you buy instead of that is going to have a higher return than the thing that you are selling. So you have two assumptions there. And
if you're planning to buy these assets back at some point in time, you're also assuming that you're going to be able to get that timing right also. That you're going to be able to identify the exact moment that you need to do that, and that from that moment on, things are going to flip, and the asset that you're buying back is now going to start increasing in value, and the other one that you just have sold is going to start decreasing in value.
So as you can see, the more movements you do to your portfolio, the more the underlying assumptions and the more complicated they get. And when you have more and more assumptions, the odds of getting them all right get lower and lower. So even though it seems lazy to do absolutely nothing, evidence shows that when it comes to investing, less is more. Number 4 is the disposition effect. This well-documented bias says that investors are more likely to sell an asset if the price is higher than the price that they bought that asset for. The assets whose price has dropped from the moment that the investor bought them, those are assets that the investors tend to hold. Normally, this effect tends to get attenuated with the investor's experience, but it is still extremely common. The cure for this is again to have a systematic approach and only sell things when your strategy, a strategy that you have already planned beforehand, says that you have to sell that asset. All the money that you invest is money that you are planning to spend at some point in time. Every investment has a time horizon. When you reach that time horizon, it's perfectly okay to sell the asset. That's the whole idea. Another good reason to sell an asset is because you want to rebalance your portfolio. Different asset classes have different returns, and if one asset class is growing faster than the other, of course, with time, you're going to get the proportions off. Also, with time, you might need to even change your allocation altogether. Allocation responds to your risk profile. These things are going to change with time. As you age, the number of people that depend on you might change, your income sources might change, your lifestyle might change, a lot of things might change, and so you might need to adjust your allocation accordingly. Or if you decide that your portfolio is not diversified enough and you want to diversify a little bit more, those are all valid reasons to sell an asset, but just the fact that an asset has increased its price, it's not a good enough reason to sell it. Number 5 is getting too much influence from the wrong sources. Evaluating all the options requires a lot of time and a lot of attention. And guess what? Humans don't have unlimited time or unlimited attention. So a lot of mistakes can be made when we pay too little attention to important information and we pay too much attention to information that is not relevant or that is outdated. Instead of having a systematic approach to analyzing all the possibilities and deciding on the best for you, most people just invest on the things that caught their attention. As human beings, it's natural to try to minimize the effort and we want to think as less as possible. Whenever we are presented with a difficult question, we try to replace that question with an easier one. So the question of what is the ideal portfolio for my needs is a very hard question, and we normally replace it with easier questions like, okay, what's in the news right now? What is my favorite Twitter user or YouTuber recommending right now? What is my broker trying to sell me right now? We have a strong tendency to end up having a portfolio that is heavily influenced by these things like what's in the media, what are people that we trust recommending, because that's a lot easier than trying to systematically analyze all the different options and trying to come up with the best for us. The choice is also going to be influenced by all sorts of emotional factors. For example, the evidence shows that an investor is way more likely to invest in a certain industry if that industry has given him profits in the past. Investors that come from generations that have seen a lot of bull markets are more likely to invest heavily and to have higher tolerance to risk than the ones that have experienced downturns in the market. Also, investors that have recently got profits tend to invest more heavily than investors that have recently experienced losses. As all this stuff may lead to mistakes, obviously, again, the cure is to have a systematic approach. And for this, you don't need to be an expert. I'm not saying that you have to spend a lot of time. You should at least try to learn the basics of investing, like what asset classes are available, which are the pros and cons of each one. For these, you could take short courses, you could read books. You don't have to become an expert. You don't have to spend a lot of hours a day staring at screens and doing complicated math and complicated spreadsheets and all that stuff. It's just spending a few hours each year on this, you're probably going to do much better than if you just do whatever your favorite influencer tells you to do. And number 6, and this is definitely the most common investing mistake, and it is messing up with timing. Dalbor Inc. is a market research firm that has been studying investors' behavior for quite a while. They have a very famous report that is called the Quantitative Analysis of Investor Behavior Study. I'm sorry, I had to read that. And this report comes out every year, and what it shows year after year is that the average investor gets lower returns than the market average. So what's interesting about these reports is that they found that the majority of this difference comes from problems with timing. That is, investors tend to get scared when the market drops, and they tend to withdraw all their assets in that moment. And that, most of the time, not always, but most of the time, causes losses. So they try to identify 10 events that led to the most massive withdrawals from investors. And for each of these events, they try to figure out what would have happened to the investor if the investor had followed one of these 3 alternatives. I know how to count, okay? The 3 alternatives were: the first, withdraw the assets; the second, apply some kind of defensive strategy with derivatives; and the third alternative was to just keep the assets. And what they found was that in the majority of the events, the alternative that was most profitable for the investor was to do nothing. Some investors have trouble understanding that the returns of a market are not evenly distributed, and it is very common that the best days are very close to the worst days, sometimes within a week. So if you panic when there is a big drop and you withdraw your assets, you're very likely to miss the best days of the markets. And we have learned that that is not a good idea, and that it causes your returns to be lower than average. The cure for this is to have, again, a systematic approach. You need to have a plan and stick to it. And that plan needs to consider regular investments. You have to define a certain day each month, each week, every 3 months, every 6 months, whatever interval you decide. You should be investing at regular intervals. Another tip is to understand that downturns are normal. You should expect them, and whenever there is a big downturn, you have to try to calm down and stick to your plan. And if you're having trouble sleeping, you might want to go ahead and find all the evidence that support the strategy that you're following. You search them, you download the papers, and you read them. You will end up sleeping better because these will either give you the peace of mind that you need, or it will bore you to death. In either case, you're gonna sleep. Stay away from the news, stay away from trying to check your portfolio every 2 seconds. If your whole plan still makes sense, you should keep doing what you're doing. Don't make changes. Stick to it, don't change it midway, be patient. So that's it for the most common investment mistakes. I hope you avoid them all, and I will see you next week.